Good morning, everyone. It is 6 a.m. on Monday, July 29th. We have a big week coming up in terms of news and earnings. So we're going to have plenty of catalysts for this market. So let's take a quick look at that first. We've got, let's see, this is probably the wrong week. Yep. Okay, so Monday, today, not much going on. Tomorrow, we've got consumer confidence. That's going to be important. And we have JOLTS, job openings. That is going to be pretty important as well. But really, this week on Friday, we have the employment situation. So JOLTS is going to help us get a small clue into what the employment situation is going to be. And then we have the jobless claims and I believe an ADP report somewhere at some time right here, an ADP report. All of those are going to help us figure out what the employment situation is going to be, and that's going to be the big report in terms of what we just went over. There we also have the FOMC announcement, which will be a big report as well. But as long as we don't get any weird, crazy surprises, then it won't have too much impact in terms of the directionality. The conference afterwards, however, that could have a major impact, depending on what Powell says, especially after this one in particular, because so many people are looking for a rate cut in September. And depending on what he says, either to kind of help people confirm or deny that, that could create not only a lot of volatility, but a lot of directionality as well. If we go over here to the FedWatch tool, let's get some updated numbers. We've got 4.1% probability on July 31st. It's basically zero. And then in September, we still have 100% priced into this market. So if Powell says anything that gives people less confidence that there's going to be a rate cut on the 18th, then this is going to drop drastically. And that's going to have a big effect on the markets, both the stock market and the bond markets. So we have to be very careful this week. And a idea to consider is maybe a strangle or a straddle on the S&P 500 or QQQ. I generally don't like to do those because they're kind of expensive, and generally the market has to move quite a bit for you to make money. But on events like this, the potential for a large market movement is heightened. And so straddles and strangles make more sense. What would have made better sense is if we did double calendars last week so that we could sell some options that expired last Friday. And that way it makes the strangle or straddle cheaper for us this week. We could still do that since the S&P does have daily expirations, but I don't know how much you're going to get for one day. If we sell some options that expire tomorrow, but buy options that are on Wednesday with heightened implied volatility, that could still be very expensive for a strangle or a straddle. But we'll see. The chances of a large movement on Wednesday are higher than normal. So that's just an idea to consider. You can evaluate for yourself whether you think that is too expensive or not. So that's it in terms of our reports. There's a lot of reports, but those are the only ones that we're going to really care about. The manufacturing index, that is going to be kind of important as well, but on a week where we've got the FOMC announcement and the employment situation, I don't know that it's going to be getting a lot of attention or focus. Let's take a look at our earnings this week. And we got some really, really, really big ones. We got Apple, Microsoft, Amazon, Meta. We have ExxonMobil, MasterCard, PG. So all of these are FANG stocks, these top four. And then we got some really big consumer staples. We've got a finance. We've got some big healthcare stocks, some big oil and energy stocks. So there is a lot going on this week in terms of earnings. It could be kind of fun to find some earnings plays, some tail risk plays. This week, we might play around with that since for the most part, we're going to be waiting for the other trades, your main bread and butter trades. I would wait, especially today. Today is not a good day to go into positions because number one, institutions generally use this as a rotation day and as a day to figure out how they're going to position themselves for the rest of the week. But with a lot of big news and a lot of earnings coming out, they're not probably not going to make up like very directional decisions. So we have this green bar on Friday, which was good news, and we did start and end above the MA50, also positive news, but it struggled quite a bit when we got close to the EMA 8. And so that did act as pretty good resistance. Looks like we're opening near that high of Friday and somewhat near the EMA 8. So it's going to be very important for us to see it cross above that EMA 8 today. And at some point this week, cross above the EMA 20 if we are going to be comfortable going long in the S&P 500. Now, with all of those reports that are coming up and with earnings coming up, I don't know if that's going to happen because like I said, institutions are going to wait, especially for that employment situation. So we might just chop, 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 chop. Or if we break back down below that MA50 and especially that 540 level, that's going to be bad news to the downside. So there is a decision to be made in this market, whether we're going to move up above that EMA 20, or if we're going to see if I can just copy this. If we're going to move down from the MA50 right here. So we are just entered a range where we could potentially chop between the MA50 and EMA 20. So we want to wait. We want to wait before we decide which way we're going to go in terms of our bread and butter trades, unless we have really high conviction, some other reason to believe that a stock can move independently of the market. So remember that stocks correlate with the sector that they're in over 70% of the time. And the sectors will correlate with the S&P 500 over 70% of the time. So there is a heavy dependency on the overall markets, and we never want to ignore it. If the market is just chopping in a tight range, we have to have a really good reason for us to go long or to go short. Unless we pair up, then it might be okay. But we're going to chop sideways. If the S&P chops sideways, the chances of any individual stock that we go into chopping sideways is really high. So for the most part this week, we're not going to focus on position trades, on things like put to go into our portfolio. We're going to stay neutral, or last week we went cash. So we're going to stay for the most part cash or just maintain the positions that we have as long as they're neutral. And then just maybe look for a tail risk trade or two during this time period because there is going to be a lot of uncertainty. Now, if one of these reports or earnings does drive us past that EMA 20 or the MA 50 before the end of the week, before that employment situation, we'll go ahead and we'll take it. We'll say, okay, if we break above that EMA 20, it's time to lean the portfolio positive. If we break below the MA 50, it's time to lean the portfolio to the downside. But until we see that happen, we're just going to sit and wait because for the most part, that's what the institutions are going to do. So let's see where we are in our futures. We can tell that they're up based on this pre-market trade right here. Let's see how far up we're talking. Okay, we've got about 45 basis points on the S&P, about 70 basis points on the Dow, and we'll call that about 35 basis points on the NASDAQ. Or sorry, not the NASDAQ. I missed 70 basis points on the NASDAQ, 35 basis points on the Dow. I just read those two, flipped those two in my mind for some reason. So significant, non-random to the upside, but we had that on Friday as well, and it was even more non-random than we are right now. And what we did is, yeah, we did go up, but we lost a lot of it. We lost more than half of the movement upwards by the end of the day. So again, we moved upwards and today, or we're opening higher today, and then it looks like we could just potentially taper off. We could hit that EMA 8. It's even possible for us to hit that EMA 20, but we'll see if it lasts, see if it sticks. We really want to be careful in this current environment. So if we look at our, yeah, and you can see this, look what happened to the Russell. It was up quite a bit and now it's sold off in the last half hour or so. It's just really coming down pretty hard. And then something similar happened in that S&P 500. We made a peak around 538 and then 537, and then we started to come down. Same thing with the NASDAQ. So far down, in fact, that in the pre-market VWAP, we crossed below it. So that actually indicates downward momentum going into the open. So when we open, there is a slightly higher chance that we're going to continue to move down rather than move up. And remember, 70% of the time, if we have a gap at the open, we will move towards the previous open, at least during the open. Not necessarily that we're going to stay that way the whole day, but the initial action tends to be moving towards the previous day open. So, what are other signs that we're going to look out for other than crossing these levels? Another good thing to watch is VIX. VIX, it looks like it was on its way down, but we've got this heightened movement upwards since the close of Friday, which is interesting because our futures are up non-randomly. They're up pretty significantly, especially on the NASDAQ, but they're non-random on the S&P 500. So our volatility is going up. That is a divergence right there. So we want to be very, very careful about that. I would be a lot more comfortable if I see the S&P 500 above the EMA 20 and VIX down, I would say below 15. Below 15. If I see a combination of those two, then I'm going to be a lot more comfortable leaning to the bullish side. Right now, it's caution, caution. I'm not going to be leaning to the downside unless I see VIX go above this 19 level, maybe 18. 18 is probably a little close, 18 and a half or 19. So I'll just leave that at the 19. So we want to watch this carefully because this is a slightly forward indicator versus the price action. So we would be watching this. Are we going to break down below 15? Are we going to go above 19? Or are we going to chop in that region? In which case we're still going to be uncertain of how that's going to play out. So this week we're going to be watching VIX very carefully. We're going to watch the price action on the SPY very carefully. Same with the QQQ. QQQ is not looking nearly as good as that SPY, but it did bounce off of a support region that we drew over here. So we'll see. We'll see. And again, the SMPY can move up without the QQQ only if the Dow Jones is participating and really pushing things upward, in which case that we would have a serious rebalancing with if the QQQ drops, the Dow Jones is moving up, that's a serious rebalance. And that's a very bearish, medium-term bearish, short-term neutral, but once the Dow Jones stops moving upwards, then the S&P and the Dow Jones would both be moving down as well, and that would become very bearish. So we're going to watch the interplay between all of the major indices very carefully. We'll throw IWM into the mix as well. Remember, we were looking for it to break above this purple line right here, and it just poked its head above it a couple of times. And so far, we haven't seen a breakout. Pre-market, we are right on top of it. So there's just a lot of uncertainty and question marks in the market, and we just want to wait and see before we start allocating. So we know what to look for. We know the major levels on the S&P 500. We know what to look for in the VIX, and then we'll just watch the results of these reports and of the major earnings that are coming out. So maybe later today I'll sort these in terms of the day that they're releasing, so we know which stock to watch out for, either pre-market or post-market, on which day. And that'll help us get a clue as to where the market might go. Okay, so that's it for this morning. There's not that much to talk about since we're in a wait and see mode, but those are very, very, very important things. Now is not the time to put money to work. That's not what institutions are going to do. That's not what we're going to do. We're just going to wait and see, except for maybe a few tail risk trades here and there. All right. Have a wonderful rest of your morning, and I will see you in the post-market session.